We have a great session on the role of private assets for insurers. And Hol is going to lead the session with us today. Can I invite you on stage? Thank you very much.
Let's have everybody going. All right, so good afternoon, everybody. I know it's usually the most difficult session after lunch, but I'm sure we'll get there. So my name is Wale Oshin. I'm the Group Managing Director of Custodian Investment PLC. We are an investment company with investments in life insurance, non-life business, pensions, as well as real estate. I'm going to ask the participants to introduce themselves. And I'll start with Emily.
Hi, I'm Emily Woodland. I'm the APAC Head of Sustainable and Transition Solutions at BlackRock, which is the sort of central sustainability function that drives strategy across our whole investment platform. Thank you for having me.
Alan.
Good afternoon, everyone. My name is Alan Kuo. I'm the Deputy CIO of Singapore Life. This is a homegrown local insurance company. I've been in Singapore for about a year. Prior to this, I was with University of California, the investments office there.
Well, good afternoon. My name is Anders Malmström. I'm the CFO of Athora Group. Athora is a life insurance group. I think we are mainly focused on continental Europe, and again, there we're really focused on guaranteed savings and pension products. So that's why I think this is quite important for us. Before that, I'm there now about 2.5 years. Before that, I was with Equitable in the US.
Great, thank you very much. So we're just going to move on from the sessions that we've had this morning, and we'll be talking now about what we do with our funds. Where do we put our funds? How do we invest our funds in a responsible manner and into sustainable, resilient investments? So I'm going to start with Anders. He's going to tell us what are the key drivers increasing allocations to private assets, and how do you factor sustainable considerations into those investments?
Yeah, thank you, Wole. I mean, I think that's quite a broad question, but if I step back and look a bit past the last 20 years, you see a big shift how life insurance companies in particular invest. I think in the late 90s, I think people still invested a lot into public equities. Obviously, we all got burned then in the dot-com bubble. And then again, I think in 08, I think the life insurance sector was following investment, was always almost behind the curve. Huh? And I think then rates came down significantly, and also credit spreads, I think, tightened quite a bit. And I think that's when I think the sector in particular realized that we need to find alternatives. We need to find all the ways to actually generate the yield that we need to provide guarantees. I mean, many companies moved out of the guarantee sectors. The one that stayed, I think, really kind of changed the way you invest. And private assets, and now talking mostly about private debt, is a real opportunity where you can generate the yield in a very controlled fashion. So I think and I'm personally very convinced, I think it's the right way to invest. It's not taking more risk, it's taking the right risk. I think the other aspect of that, I think it's also a need in the real economy. Mm-hmm. And by going private or by investing into private, you actually provide financing opportunities to a lot of institutions that don't have access to the public market, that don't, either from a timing perspective or from a capability perspective. And so I think that's an area where you can then sync up with really align the interest between the real economy, who really needs financing, and the life insurance sector that needs long-term guarantees and a yield that corresponds to the risk. that the public sector just doesn't give anymore. So that's really I would say, the main source. And that then, to your second part of the question, that then also gives a link to sustainability, because, as I said, I think you provide access to areas or kind of counterparties that don't have access, and many of them are in the sustainability area. So for us, when we invest, we do a real assessment in all dimensions. Sustainability is quite an important point for us. We want to make sure this fulfills our needs, and so I think that's, in a way, how we can bridge particular need for yield, but also a need in the real economy for financing, but in a very sustainable way.
Okay, that's quite interesting. I know I'm still going to be talking more about sustainability when I get to Emily. But I mean, this is an industry that, has over $22 trillion invested in private assets. And so, Alan, in terms of market cycles, what's the impact, what investment strategies, have you put in place, or do you put in place, where it concerns private assets, especially during the market cycles?
Yeah, so we definitely care about market cycles, but with respect to private assets, generally speaking, we're not going to be moving them around that much. So, currently, the equities market, especially in the U.S., is probably near the highs, even though there was a pullback last year. So we're going to be adjusting, our public market assets just simply because they're liquid. But the private side, we generally will separate that out. We're looking for very long-term, sustainable returns with our private assets. We appreciate the less of the lower market volatility of these assets. So that's very helpful to us. But generally speaking, we're not going to be playing around with that too much. We're going to make sure, even though there's a lot of uncertainty in this world, we're going to make sure we keep on investing in privates, make sure we have vintage year diversification. So we'll continue to do that. So this may not be a market cycle, but I think the key issue on everyone's mind are interest rates, really. So the question is, going forward, for your very long-term strategic asset allocation, are you making any adjustments there? These are the conversations we're having internally right now. Private equity buyout, has performed very well historically. Do you assume those same capital market assumptions going forward, or will there be headwinds? So we've seen since like 1980, generally speaking, yields have come down. That probably has been a great tailwind for private equity. Interest rates had been on an upswing from 1950 to 1980, right? So these cycles, these trends can last a very long time. Can we be in a decade or longer of higher interest rates? These are the real issues that are, come to mind for us. We haven't made any adjustments to our CMAs yet, but we're definitely looking at potentially diversifying into commodities. I don't know. I'm relatively newer to the insurance sector. I don't know how much they have been loaded onto commodities, but inflation is something that at a pension fund or endowment you really have to worry about, and that has influenced my thinking because of a previous job. So that is something I'm thinking more in terms of in our strategic asset allocation.
Fantastic, thank you. So Emily, do you want to tell us, where infrastructure is concerned, what role, does infrastructure play in your investment portfolio? And what are the emerging trends in the space?
Yeah, sure. And I'm going to try and build on some of what Alan was saying, but also try and bridge with the previous session that was obviously sustainability focused. But I think today, more than ever, infrastructure investing is really gaining traction, and that's thanks to technological advances. It's also due to policy tailwinds, and also the huge opportunities that we're seeing to build more sustainable infrastructure. And infrastructure is increasingly adding diversification, resilience, and stability to long-term investor portfolios, and that includes our insurance clients. And I think the nature of infrastructure assets, a lot of which are backed by visible and durable income streams, makes them lower risk, defensive instruments, and they're more resilient, as Alan said, to short-term market volatility. And the types of projects that are typically backed by these investments are often quite essential in nature, which means that the cash flows can be more stable even in periods of economic downturn. And they also typically have low correlation with traditional assets. And they can also be used to diversify macro risks, which, because they have quite idiosyncratic characteristics, because they're often kind of bespoke in nature. So also, if we, and you touched on this, Alan, but if we're expecting inflation to stay higher for longer, then infrastructure has a really key role to play in that in a portfolio. And that's for two main reasons. Firstly, when we're talking about the revenue side of these assets, often infrastructure involves securing long-term contracts, and often these contracts have got inflation hedges built into them. And then on the asset side of things, infrastructure assets do tend to rise in value with inflation, whereas the expense side of things can be a little bit stickier. So you can actually find that the margins of these projects can expand in a inflationary environment. In terms of portfolio positioning, we tend to find that our insurance clients access infrastructure through two main ways, but there's a lot of different risk-return profiles even within these categories. But broadly, if you're talking about infrastructure debt, and actually 75% of our infrastructure debt assets under management is actually held by our insurance clients. And the reason it's appealing to insurance clients is, I guess, there's three main reasons. One is income reasons. So typically an infrastructure debt asset can yield more than an equivalently rated public corporate bond of an equivalent description. As well as when we talk about protection, typically the default rates can be lower in infrastructure debt than it is in the equivalent corporate public debt as well. And lastly, and I think this is particularly relevant for insurers, there's asset liability matching potential. So if you talk about investment grade infrastructure debt, you can have much longer duration, which is useful in terms of matching the long-term liabilities as well. And then on the equity side, if you're investing in diversified infrastructure, climate, evergreen infra, you're looking at consistent dividend yields as well as attractive capital growth, as well as a lot of the diversification and the stability and the resilience benefits that I mentioned earlier. If we talk about specific trends that you were asking about, and this ties into some of the comments that were made in the previous section, the transition to a low-carbon economy is one of the 5 megaforces that we at BlackRock think is going to really shape economies and sectors for decades to come. It's really a full-scale rewiring of the global economy. It's going to touch every sector, every company, without fail. And over the next decade, we're expecting $4 trillion of investment to go into the global energy system through to 2050, and that's up from about $2.2 trillion right now. And that's just the energy system. There's increased impacts, from a downstream perspective across technology, across transportation, across manufacturing, real estate, and more than that. And this opportunity is going to impact like all asset classes. But in particular, when you're talking about private markets, when you're talking about the transition, you're really talking about switching out operating expenses for CapEx, which often involves like a lot of upfront financing. And that's where there's a really vast opportunity for private markets to play. And this isn't even just about funding the development of new technologies. This is about scaling them once they're proven, and that's going to be massive investment in scaling renewable generation activities, strengthening the reliability of the energy transmission and distribution systems, building all of the enabling infrastructure that we need for electric vehicles, and rolling out next generation breakthroughs in the more hard to abate sectors that we haven't even quite figured out yet, like carbon capture and a lot more. And I don't think we can really ignore in all of this that the policy tailwinds that are really driving this at the moment, that is really building the momentum for private investors to invest in infrastructure. We've got the USA with the Inflation Reduction Act. We've got the EU Green Deal. We've got regionally, even here in Asia, we've got Japan's Green Transformation Plan, which is planning to roll out $1 trillion of public-private spending in the transition over the next decade. And we're expecting a lot more policy stimulus like this across regions and sectors in the future.
Thank you. Interesting. So, Alan, do you want to tell us how you balance the need for liquidity with long-term nature of most of the private assets investments that you do?
Yeah, so at Singapore Life, generally we are a life insurer. So our liabilities tend to be very long. So privates are a natural fit for us. The fact is, privates are new to Singapore Life. It is possible that in Asia, the local players probably have less exposure